Okay, now we have a presentation from Funding Circle.
Funding Circle is the largest peer-to-peer lending marketplace exclusively focused on small businesses. So as you guys have probably heard in the media, in the interwebs, wherever, it's been tough the last 4 to 5 years for small businesses to get capital to continue to grow. This is incredibly important because small businesses are the drivers of our jobs in our economy, right? Like I think 2/3 of our jobs are created by small businesses. Over the last 4 years, there's been a material shift in the amount and the number of loans being made by typical banks, and the amount needed by small businesses continue to grow. So Funding Circle, which is now a $700 million lending organization, has been created to fill that gap.
Just by a show of hands, how many people here have heard of Lending Club? Got you. So Funding Circle is a very close analog to Lending Club, but we focus specifically on commercial credit. So Lending Club does a great job of filling the market for consumers who, for the most part, want to refinance their existing credit card debt. We believe that there is a much more compelling reason to enter the peer-to-peer lending market, and that's really to help finance and fund entrepreneurs. People who might be opening a mom and pop shop, might be starting an e-commerce company, but for whatever reason, as Brian mentioned, can't find the finances to fund their business and grow it through traditional financing options. So if you can look here, you can see that small business plans to increase hiring have only expanded in the wake of the financial recession over the past 5 years. But bank lending under 1 million is just going down. Basically, it does not make sense for large financial institutions to make these types of loans anymore. They're looking at larger ticket items because it just doesn't come out positive for them if they're underwriting loans that are under 1 million. That's where we come in.
So our solution, we seamlessly put together borrowers who are looking to take out capital, to invest in hiring, to invest in new locations, to invest in equipment, and match them with institutions who believe in that dream and are willing to fund that at scale. So as I mentioned earlier, we've now originated and funded over $700 million of capital between the US and the UK. And these are strictly small businesses, so this is not like the $50 million or $100 million business that could be technically a small business relative to the Fortune 500. This is the old shipyard saloon, right? This is the local wing joint. This is the medical practice down the street that takes care of you or your kids. And we believe that we're helping our local economy and obviously society and changing the world by creating a pathway for capital to access and be put into the market so that our economy locally can grow. So within any capital transaction, there's always a fee charge, right? So, obviously, if you're an investment bank, you're taking somewhere around 5 to 6%. For local small business banks, Bank of America, Wells Fargo, they're going to charge an array of fees, everything from the origination fee, which could be as high as 5% for that bank. In addition, listing fees, guarantee fees to put it on the market. And then some organizations will actually also put on, like I call it another fee on top of each individual principal payment to try to accelerate the principal coming back to them. Funding Circle's capital and product is very unique in the fact that we only charge the origination fee. So you, the borrower, take out $100, we will charge a 3% fee, and that's all you see. So if you want to pay the loan back early, that's fine with us. If you have to restructure it due to some financial issues, that's fine with us. We'll figure it out. So high level, we are very clear and upfront with our borrowers about that one fee. And relative to the check boxes of other fees from other banks, we have one. They could have anywhere from 3 to 6.
So this is one of our borrowers. Her name is Tanya, and she runs a pediatrician's office in South Carolina. She is not very informed about financial technology, probably cannot tell you a lot about Bitcoin, and was looking around for an alternative financing option when banks wouldn't give her the funding that she needed to open up a pediatrician's office. It had always been her dream to do this business. She found us online by searching for us and searching for alternative capital sources on Google, filled out an application that took her about 10 minutes online, and without ever meeting her, we were able to fund her business and have heard since from her that she's been able to hire new employees, buy new equipment, and expand the number of patients that she treats. We lend anywhere from 2 to 5 years. So this is really business growth capital. We're not trying to recapture all of our principal over 3 or 6 months. We really want businesses to be able to grow and then become even better borrowers over time with us. And so it's really a relationship business that we're trying to establish. With that being said, these businesses never actually come face to face with us. They don't walk into our office. We don't walk into theirs. So it's this kind of platform and the scalability that really lets us make an impact across the country, even though we only have an office here in San Francisco.
So to Nick's point, we've raised money from people who've heard of us, or we've all heard of. Why is that? Because this is an incredibly important problem that needs to be solved. As I mentioned and opened, there has been a significant drop-off in the amount of capital coming into small businesses. So the businesses that you and I frequent every day for our coffee, for our shoes, and even just for the lunch that we eat, consistently have an issue with access to capital. We've been backed by VCs that you've heard of, who've backed companies that you've heard of, to tackle this problem and to continue to build out the technology, the team, and the reach of our product within the United States and internationally so that we can solve this problem, not only just locally at home in our own backyard, but for people everywhere looking to build and grow a company. That's what's really important to us, and part of the reason we wanted to come and connect with you guys, because we think that there are people here who it's very important to as well.
And this is the recruitment slide. This is where we pitch you to come work with us. We're obviously very passionate about this problem. We think everybody here is here tonight because you're passionate about financial technology in one way or another. And we think we've built out a great team to tackle what we see as being a pervasive issue with what we think is a very innovative solution. Financial technology as a sector continues to grow quite rapidly, and we're very happy to be part of that rising tide. But it's a really engaging problem, and we definitely are always looking to expand the team of people we work with on helping to figure out even more and more innovative solutions. We're also based right out of here in San Francisco, and we have an office over in London, which is the original office for Funding Circle. And we'll likely be expanding geographies in the next coming years. So I'm more than happy to talk about that afterwards. And that's us.
That's Funding Circle in a pitch. I'm happy to answer any questions or now or over beers. So,
Francois, just wondering, like, do you know what how big is the market basically? Like how much sub $1 million loans are there to do like every year, something like that? And like, what's your market share, I guess?
That sounds like the question our board asks us every quarter. We think that there is a very significant market gap. If you look at total business lending at our size in the US, the market is something to the tune of $290 billion. That gap also represents about $50 billion in unmet demand. So that's in addition to current financing. We think that this is a huge problem. To put that in context, we've lent Lifetime about $600 million. So we are still a tiny, tiny portion of this addressable market. I'm not sure if that answers the full question or not.
there's 50 billion.
Sorry, so you're saying there is you're saying there is 50 billion of uncovered basically like loan demand. So there's a huge growth potential to the entire industry, not only you guys, right?
That's exactly right. So the way to think about it would be if you were to categorize it by band, so let's say equipment loans and expansion investment, getting capital from your father-in-law, your uncle, in total, that would be, call it 200. In addition, because people have just effectively given up, so similar to our unemployment rate here in the country, right? There's an additional 50 million of that people are looking to get that they've just given up on finding. And so from that math, we've said you call the entire market somewhere around 250 bill. If you just look at loans that are, I think, $1 million or less, correct me if I'm wrong, but I want to say it's around 116 billion. So to put that into context, we are, without a doubt, the largest exclusively focused small business lender in this market, technology-enabled, peer-to-peer, however you want to define it. And we've only scratched the surface with what we've done in the last 4 years. And so there's a lot of wood to chop just within this country, let alone the entire world.
Do you think the business is really leverageable, like in the sense that the more like customers you want to get, like on the borrower side in particular. Like the more people you're gonna need to like check their credit and like check that the loan is actually a good quality or whatever. Like you're gonna need a lot of people to like check all these like small borrowers. Like I don't know. I'm just wondering how that works and if it's actually leverageable.
Yeah, that's a good question. So the spirit of your question is really like how much does technology help versus how much of this is like human eyeballs and human hands and feet working on it, right? So I'll put it to you this way. So the last time I looked at the math, actually a bank told us this, it costs them around $8,000 to $20,000 to originate and underwrite a loan, right? So that doesn't matter if it's $1 million loan or if it's a $100,000 loan, right? We can do it for 3% of the capital, right? And our average loan size is $150,000. So you can do the math on that, right? And we do that profitably. It's a combination of things. One, we've streamlined the actual operation of underwriting. So the human part of it has been done more efficiently. And then part of it is our data integration. So we can more efficiently pull in data either from QuickBooks or other sources that allow us to do a lot of this stuff earlier. So technology actually has an impact on our ability to underwrite much more quickly, just from the simple fact of our ability to integrate and also create our credit models automatically.
God damn it, that's what I would have appreciated getting out of my video. So Stu, I'm a finance manager based in San Francisco right now. First question I kind of had on this one is I thought you said peer-to-peer, but you mentioned you're venture funded. Your capital base essentially coming from those guys, or are you actually out and getting a lot of people bringing money to you and then matching?
Good question. That $123 million number that we've referenced, that is all equity, so operational capital for us. We actually go out and raise from accredited and institutional investors. So our debt capital is completely separate. But we go out and anybody from a family office or an institutional side investor or even individual accrediteds can invest in our platform in the businesses themselves.
It's probably worth mentioning the UK government too, giving us cash.
Oh yeah, that is a good one to mention. And then in the UK, this is a business model that hopefully we'll be able to replicate here. The government also has a very presiding interest in funding these businesses. So we've raised about $65 million from the UK government to help fund the businesses on our UK platform.
Okay, and then the next piece is one of the things that we do as a large business, and we're going through and we're bringing new customers on, is we do credit apps. Is there any kind of expectation from you guys to move into the market where you would be doing credit app software for large enterprises who are doing large trade credit? Or would you be staying with this? Would that have a valuation in that space?
So the board, the directors, and this group of guys are super focused on the equity value tied to the marketplace aspect of what we do. And so for the foreseeable future, I would argue that that's where we're going to stay. I mean, if you just look at the people on here, they made a lot of their money on marketplaces, right? Oh, does that answer your question, Stu?
Yeah.
Yeah.
So the answer is no in the short term.
Yeah. With an
Let me just stand up. Just get the camera on.
So my name is Sina. I'm with Plug and Play Tech Center. I was wondering, how long have you guys been around? And then also, how do you deal with the high default rate? Because there must be a higher one because you're going after the markets that the banks aren't taking. And then if it isn't private, what default rate would you have to get to break even?
So, okay. First question, remind me again, because I stuck.
How long have you been around?
How long have we been around? So we were founded in the UK in 2010, and collectively we've been around for 4 years. We started the US entity in 2013, 2012? 2012. So yeah, and then it was acquired and merged with the UK entity in 2013. So been around for, call it, 4 years. That being said, from a default rate perspective, we're actually relatively low default rate in both geographies. So not as low as, say, a bank, but definitely not as high as the merchant cash advance guys. We're definitely single digits. Your profitability question's a good one, but it's also slightly bad timing to ask that because as any VC-backed company is, we're not super focused on that. So there are a lot of other levers we could pull to be profitable right now that we're just not doing because we're super focused on building the product and scale. So, yeah. But if you join the team, we can tell you everything.
So you're recruiting, right? Yes, you're recruiting.
Yeah, I mean, so we came to this event the last time it was held, and we're just really impressed with the talent, the level of questions and engagement, and so we thought that it would be productive use of time to just let you guys know what we're working on. Like, we've been fans, and we're fans of you guys, and if there's anybody else who's interested in tackling this problem, either in a partnership perspective or as a part of the team, we're happy to have those conversations, so.
Hi, my name is Ipsy. You mentioned the underwriting process. So I just want to know, in what ways do you reduce the human costs needed to basically underwrite? Could you give some examples?
So it is a really delicate balance. You know, we're not an automated underwriter, and the human touch is very important for us. With that said, there's more and more data available about businesses in a wealth of different areas that's accessible online and through different private services. So, without kind of going into boring, grainy detail, we can pull bank information, tax information, background check information, and then look at kind of more amorphous variables that normally aren't tied to credit in financial institutions, like social media presence, Yelp score, and pull all of this into a pretty, for a startup, sophisticated underwriting rubric that we're constantly modifying. And so this accessibility of automation really helps us underwrite in not only a very quickly scalable way, but a way that also minimizes the application time and cost for us.
Yeah. I mean, just to add a specific case study to that, so we just launched an integration with QuickBooks. And so any business that's on the QuickBooks platform can apply to us directly and send effectively all their financial statement information to us immediately, which then populates a lot of our underwriting models. And so we can manipulate that data into the algorithms we need to say, good credit, bad credit, and all the other different ways we want to look at the information. In today's world at a bank, that takes a lot of effort and a lot of people just like looking through tax filings and then asking you to print out your bank statements or give me direct access to your QuickBooks, and then hopefully the loan officers understanding how to even look through the QuickBooks and the digital version and then put this into a useful information format. So just that one example, which literally we did in the last month, cut down a ton of time. And then on the back end, there's a lot of there are ways to automate the data populating in the model, even if it's in a PDF form that we've started to use to allow us to just automate physical manual entry into our credit models.
How long does it take to process?
Okay, I don't know how many times I have to say this.
The question was, how long does it take to process the loan by Sina? Yes. We typically say if the borrower is responsive to us, so you know how it is, like sometimes people are like, I didn't see that email, et cetera. I know I don't respond to my accountant within like 48 hours, so I get it. But typically from app to cash in pocket, 14 days. We can do it in 7 if it's like a huge rush. I think the average bank turnaround time is like closer to 4 to 5 months.
So my company is thinking a lot about this. So we just got out of a meeting about this. So that's what's on the top of my head. But with all the new data that's just come out of like Google and everything about biases, have you guys thought about eliminating parts of forms or have you guys considered trying to eliminate biases in terms of like gender, race, anything, location when considering applicants?
That's why they hired me.
Yeah.
That was a little hanging fruit. Drop the mic.
Yeah, it's over. No, we think that is a huge part of our value add. Honestly, we actually have a lot of surveys that we've collected, not that we've collected, but that we have in-house that show that there is persistent bias in the capital application process for small businesses. And if you look at application acceptance rates from banks with face-to-face, face-to-face interactions, bias plays a huge factor. And so we think that part of this model is going to eliminate that, and it's actually a market efficiency when you look at it, because we'll be funding better businesses without being kind of held back by bias.
Yeah, actually, to build on that, Nick made a really good point. So from our end, we do get to know the borrower a little bit. Like there's a phone conversation that happens, and we try to get to know the story. One thing that I glossed over was that Funding Circle was started by small business owners who were looking for a loan, and despite the amount of capital and collateral they had, they just couldn't get the loan because they didn't fit the right mold, they weren't looking for the right amount of money, et cetera. So that being said, we're very sensitive to the plight of the small business owner. In addition to that, the people who actually fund the loans, so those accredited investors, institutional investors, do not get very much more information than the credit data. So from their end, they're looking at this as, here's the data, let me run my own model on it and decide whether or not I trust Funding Circles. Can you take a message for me? So they're deciding whether or not they trust Funding Circles underwriting and are looking at our credit worthiness generally and then make the decision to fund. So to Nick's point, the capital inflows are judging the opportunity based on the data presented and less so on the person, right? We get to know the story so that we can know, hey, look, like, we'll work with you if there's something to work with. Does that make sense? Cool.
Okay, that's very cool. Guy, thank you very much. Thank you.
Thank you.